Okay, hello, good morning, everybody. My name is Jason Simon. I am a senior tax manager here at Kraft Berger. I will be presenting today with Jessica Jin, who's an accounting manager here at Kraft Berger. And as you all already know, but I will reiterate, the topic today is professional real estate corporations, which there has been legislation introduced that now allows realtors to incorporate. And we're going to talk today about generally what that means and the characteristics that these corporations have. And we're going to talk about some of the tax considerations, most of them benefits that may be applicable to you if you choose to form one of these corporations. That's where we're going to go. So I'll just start with a little bit of housekeeping. The first thing is if you do have questions, we will have a little time allocated for questions at the end. If you could type your questions in the chat window, and at the end, Jess and I will take a little bit of time to go through them and try to answer a few of them, depending on how much time we have. We'd ask that if you do have a question, if you could please just leave your name and email address, of course, if you feel comfortable with it, because if we don't have time to answer all the questions, we would be happy to take a look at them after the webinar is complete and send you an email shortly with a response. And other than that, we'll get into it. So, okay, there we go. So just a quick summary of the agenda, and then I'm going to turn it over to Jessica. She'll be speaking first. We're going to start with just a general background of these professional real estate corporations, what they are, how they work, and the criteria that need to be met for them to be in compliance with the legislation. Then we're just going to talk a little bit about the difference between earning income from self-employment as an individual versus earning income through a corporation. Then we're going to talk about potential tax deferral opportunities that may be available if you use one of these PRECs, professional real estate corporations. We're going to talk about income splitting and maybe some opportunities that may be there, but also some limitations that are imposed by the current rules that can prevent people from effectively splitting income. And the last thing we're going to talk about is transferring assets to professional real estate corporations. If you have assets in your individual practice that you want to transfer to the corporation, we'll talk a little bit about how that can be achieved. So now I will turn it over to Jess.
Thanks, Jason. Good morning, everyone. Hope everyone is doing well and keeping safe during this pandemic, which we don't know when will end. At least we have some good news, PREC. As you may know, effective on October 1st, 2020, real estate broker and salesperson in Ontario are allowed to incorporate their personal real estate corporations, which we will address as PREC in our presentation. The ability to incorporate, currently available to lawyers, accountants, doctors, had not been available previously to real estaters. Today, we're going to introduce the criteria and conditions. I will cover this part, and also I will cover the comparison between self-employment and PREC, and Jason will cover the rest. Okay, let's start. Next one, please. There are certain requirements when you incorporate your PREC. First, it must be incorporated under the Ontario Business Corporation Act, which means the PREC will be an Ontario corporation. In terms of the share structure, all the equity shares should be legally and beneficially owned directly or indirectly by the controlling shareholder. The term directly or indirectly suggests that the shares may be held by the realtor personally or through a holding company. And the controlling shareholder is the registered broker or salesperson. In addition, the sole director and president of the corporation must be the controlling shareholder. Basically, as the registered broker or salesperson, you will be the only shareholder of the equity shares and the sole director and the president of the company. You have the full control. For the non-equity shares, it can be owned by the controlling shareholder the controlling shareholders' family members, including spouse, child, parents, or owned by a trust for minor children. The share structure will potentially influence the future tax planning opportunities. Okay. A PREC is exempt from registration under Real Estate and Business Broker Act and is permitted to receive remuneration from a brokerage if the PREC meets all the required criteria and satisfies all the conditions set out in the legislation. First, the controlling shareholder, which will be the broker or salesperson, must be employed by a brokerage to trade in the real estate. And the PREC itself cannot carry on business as a brokerage. The legislation uses the word employed. However, generally, a realtor would be earning income from self-employment for tax purpose. This is just the difference between a legal term and an accounting term. Basically, the way you earn income before or after a corporation would be very similar. The difference is that the brokerage will pay the PREC instead of the realtor. In this case, the income will be corporation income instead of personal income. Also, the PREC cannot carry on the business of trading in real estate other than providing the services of its controlling shareholder to the brokerage. And the PREC cannot receive remuneration for trading in real estate from any person or entity other than the brokerage. Basically, the PREC's income from trading in real estate can only be from the brokerage, and the services have to be provided by the controlling shareholder. In addition, the controlling shareholder can only receive remuneration for trading in real estate from the PREC or the brokerage. All these limitations are about the remuneration allocation for the income from trading in real estate. Outside of the limitations in trading in real estate, a PREC is not limited in terms of other business income. For example, if there are extra money sitting in the PREC, you can use the money to buy stocks or buy a rental property to earn investment income. However, there may be limitations on the corporation if it is used to operate in another regulated sector. The situation is different case by case, but this is the general idea of the limitation on the source of income. Okay. Also, the PREC is controlling shareholder and others are not allowed to present to the public that the PREC trades in real estate. You are only allowed to use your own name, who is the registrant, and the brokerage to advertise. The interesting part is that the Real Estate and the Business Broker Act does not impose requirements on the name of a PREC. Like you can name your PREC the way you want. However, because the PREC cannot be promoted or advertised as being able to provide real estate trading services, it may be a consideration to not name it in such a way that would suggest or imply it's a brokerage. Also, the PREC does not hold any money or other property of a client, customer, or other person in connection with trading in real estate. It'll be similar as before the incorporation. For example, your client will still pay the deposit to the brokerage trust account. You don't need to set up a trust account or incur any related administration costs about it. In addition, there must be a written agreement between the PREC, the controlling shareholder, and the brokerage governing the relationship between them and addressing certain conditions. There is another point I want to point it out. A PREC is not a registrant, so it is not insured by the Real Estate Council of Ontario's insurance program. A PREC is like any other non-registrant corporation and should be insured against the risk it may face. Okay, that's all about the conditions and criteria. Now let's talk about the comparison between self-employment and PREC. Before the incorporation, you are reporting trading in real estate income on the personal income tax return also known as self-employment income. It has less administration cost. If you will incorporate, there are some additional costs. For example, initial incorporation legal fees, probably ranging from 1,000 to 2,000, depending on the lawyers. You will also need to update corporate minutes every year. It's an annual legal fee. In addition, if you are filing your personal income tax return yourself right now, if you will incorporate, you may need to pay additional accounting fees every year for the financial statements and corporation tax return preparation. Also for HST filings, payroll forms such as T4, However, if you already have an accountant to prepare your personal tax return and financial statements, the additional cost will be smaller. Personal tax return filing has a fixed deadline of June 15th if you have self-employment income. The payment deadline is April 30th. And if you are required to pay installments, it's quarterly installments due on March, June, September, and December 15th. There are less flexibility around here for personal tax return filings. Okay, for the PREC, next one, please. The corporation filing deadline is more flexible. The deadline is 6 months after your taxation year. You can choose your own taxation year and for the corporation, and then the deadline will be 6 months after that. For example, you can choose the taxation year end during your slow time so that you have time to prepare the paperwork, etc. The payment deadline is 2 or 3 months after the year end, depending on the size of the company and some other criteria. If the corporation is required to pay the installments, then it will be a monthly installments comparing with the quarterly installments for personal tax. All these are all the admin part of the PREC. The biggest potential benefit for PREC is actually the tax deferral and income splitting opportunities. Jason will address these benefits into details. Now let me hand it to Jason. Thanks.
Okay, there you go. Okay, so as Jess mentioned, we see the biggest benefit in terms of the tax advantages of these PRECs really being a deferral of tax that may be available depending on how you structure it. Now, and this is what I'm about to explain is not only true with these professional real estate corporations. This is a general concept that can be applied really to any income earned through a corporation versus income earned personally through sole proprietorship or through self-employment earnings. And just to illustrate it, we have a little example here, but the general concept is if you earn income through self-employment or as a sole proprietorship, the income you earned is taxed at your personal tax rates, which are based on your marginal income tax rate and the amount of income you have and a number of other variables. But every dollar of income you earn is taxed at your personal tax rate as you earn it. Now, if you were to incorporate, the way corporate tax works is the corporation earns the income. There's a level of corporate tax, which is payable on the income. And after you pay the corporate tax, the after-tax amount that is left to the corporation can either be paid out to you as the shareholder, or it can be retained in the corporation. And the reason this provides a tax deferral is because if you choose to retain that after-tax income in the corporation rather than pay it out to yourself, you will defer that second level of personal tax until the time when you actually do pay the money out to yourself as the shareholder. And therefore, there is this deferral. And generally, once the money comes out to you personally, and this isn't always true, and there's a lot of complicating factors that can affect this, but generally, once the money comes out to you personally, the combined corporate tax and personal tax should more or less, or the system is designed so that it more or less replicates what you would have paid had you earned the money personally without the corporation. But again, because you don't pay the personal tax until the money comes out, there is a deferral until that money comes out. And so to illustrate this, to try to help you understand it a little bit better, we have this example here. So let's assume that the realtor, the agent, earns $420,000 of net income after deductions. So they have their commissions, they deduct their relevant expenses, their promotion, their meals and entertainment, etc. And they have $420,000 of net income after deductions. Assume that person needs $120,000 of after-tax income to cover their living expenses. So what would happen in that scenario, if you were earning that income through personally without a corporation, you would pay personal tax of approximately $191,000. And we've made some assumptions. We've assumed that you have no other income. That $191,000 includes CPP, which self-employed persons have to pay, and we'll get a little bit more into what that means in the corporate context after. But you would pay approximately $191,000 of tax, and you'd be left with $229,000 of money after tax to do what you want with it. Now, assuming you need $120,000 to live, as we said before, you would have approximately $109,000 left, which you could then invest or save, invest, however you want to look at it. Now, let's say you alternatively earn that money through a corporation. So same facts as the previous slide. You have $420,000 of pre-tax profit. You would pay corporate tax of $51,240. And now that number assumes that you're going to be eligible for what's called the small business deduction, which is a low rate of corporate tax for certain qualifying corporations that meet that criteria. I'm going to get a little bit into a little bit more detail of what that means and how that small business deduction rate can either apply or not apply in a bit. But for the purposes of this example, let's assume you're eligible for the small business deduction, which in 2020 is 12.2%. So you pay 12.2% corporate tax on that $420,000 of earnings, which leaves you with $368,760 of after-tax earnings in the corporation. And now this is where the deferral comes in, because now you have the choice. You can either leave that money in the corporation, or you could choose to pay that money out to yourself. And in this example, we're assuming that you're going to pay the money out to yourself as a dividend, but there's other ways to pay the money out to yourself, and we'll talk about that in a little more detail in a bit. But assuming you decide to pay it out as a dividend, you would need to pay yourself a $160,000 dividend to yield $120,000 of after-tax income, because a $160,000 dividend would result in approximately $40,000 of personal tax. And after the $160,000 dividend, you still have $208,760 of money left in the corporation that you could then invest. And if you remember the last slide, that number was closer to $109,000. So by earning the income through the corporation, you have essentially deferred a tax such that you have $100,000 more to invest in your corporation and earn a return on, which over time, if you're doing this every year, can obviously be considerably powerful and can allow you to accumulate significant investment capital within these corporations. Now, so that is the basics of the tax deferral provided by corporations, all corporations really, but is really the powerful tax deferral that you can get from incorporating if this works for you. Now, I just want to reiterate here, the deferral is really only available if the amount you're earning after corporate tax is more than what you need to live on. Because if you are going to take all of your after corporate tax earnings and simply pay it out to yourself because you need it to fund your living expenses, then there really will be no deferral, because you're going to pay personal tax on all of that income that you're taking out of the corporation. So the important thing to understand about this, and really I think what'll be the number one important factor in determining whether or not this tax deferral is going to work for you is how much money do you need to live, and are you going to be able to leave money in the corporation and use the deferral, or are you simply going to take it all out in the year you earn it? Because if you take it all out in the year you earn it, the deferral will not be there. Okay, and just a couple more thoughts on the tax deferral opportunities and just some observations on that. As I said before, given our example, you end up with approximately $100,000 more of additional capital to invest if you earn the income through a corporation. Okay, and then let's talk about the small business deduction again, which I touched on before. So as I said, the small business deduction allows corporations to pay tax on income below $500,000 annually at a rate of 12.2%. Now, that $500 threshold is based on an associated corporation basis, and associated corporations, without getting too technical about what they mean, is there are certain corporations that have some sort of common ownership. So if you own a corporation and maybe you own shares in another corporation, that would be an example might be an example of an associated corporation, depending on the facts. But I think what's important to understand is you might have to share that $500,000 limit between multiple corporations. But what's also important to understand, and this is actually a new rule that was just introduced a few years ago, is that once you earn a certain amount of investment income within a corporation, and the number right now is $50,000 of investment income where these rules start to kick in. Once you earn $50,000 or greater of investment income annually in a corporation or an associated group of corporations, you start to lose your ability to claim your small business deduction. And what that means is if you're earning, let's call it too much investment income, more than $50,000, your income that's going to be eligible for that 12.22% tax rate, your active income from your real estate business is going to decline, and you'll start paying a higher tax rate on your active income from your real estate business. Now, that being said, although the small business rate begins to be clawed back, the highest marginal tax rate the highest corporate tax rate in Ontario right now is 26.5%, which is still lower than the highest marginal personal tax rate. So even if you start to lose your small business deduction, there may still be a tax deferral opportunity available to you, because the corporate rate that you're going to pay on active earning is likely still going to be lower than the rate that you would pay if you earn the income directly through, as an individual, through your self-employed earnings. So I think the important thing to understand there is, as the investment income in the corporation starts to creep up, and if you think about what you're trying to do here, presumably if you're leaving a lot of money in the corporation to be used as investment capital, over time that investment income will increase. Over time, you may start to lose your small business deduction, and the benefit of the tax deferral is going to decline. But given that a lot of these PRECs will be starting from scratch and maybe won't have a lot of investment income at the beginning, you will probably have a number of years of small business deduction or small business rate earnings before you get into this higher corporate tax rate when your investment income is too high. So that's something to think about. Okay, and then the next thing, if you remember in our example, we assumed that the money comes out of the corporation to the shareholder as a dividend. Now, that does not have to be the case. There's also the ability, if for these corporations, for the shareholder to draw a salary, so employment income from the corporation, and pay out some of the employment income to themselves. And what that means is, if you earn the corporate earnings, rather than have the earnings taxed in the corporation, you pay out yourself a salary or a wage, whatever you want to call it, employment income, which is then a deduction to the corporation, which reduces the amount of personal tax, but you will pay personal tax on that rate, and the personal tax rate on that will be higher than the dividend rate. However, when you look at the way the combined corporate and personal tax rates work together, it may actually make sense for you to take the money out as a salary as opposed to a dividend. And there's a lot of variables associated with that. And that's why often with these professional corporations, you really need kind of a custom strategy where you look at your income, your income, your living expense requirement, and you really have to look at how to tailor the remuneration strategy between salary and dividends to suit your specific circumstances appropriately. And just one more thing about salaries, and a reason that we often like to use them in these professional corporation contexts is because unlike dividends, if you pay yourself a salary or employment income, that creates RSP room, and you could then contribute additional amounts to your RSP, which, as I'm sure a lot of you are familiar with, is another very powerful tax strategy in terms of accumulating money for retirement. So often we like to use either a combined salary dividend strategy or one or the other. And again, it really depends on the facts of your specific situation. And then the last thing about the tax deferral, and then I'll move on to the next topic, is that because you're retaining the money in the corporation that you don't need, you have the discretion as to when you want to pay it out to yourself, and you can therefore pay it out to yourself gradually in future years and smooth your income so that you take out money over a number of years, which can then take advantage of your marginal tax rates in the particular year that you take the money out of the corporation, and you may end up paying a much lower tax rate on the income when you take the money out if you spread it out over a number of years. Okay, so that's it for the tax deferral. And again, I think for most people that will be probably the most powerful benefit of these professional real estate corporations. This next one, there's some limits on it. I think it might be beneficial for some people, but I think if we were talking about this a few years ago, then I think it would have been considerably more beneficial for a lot of you. But unfortunately, the rules changed a few years ago, and now the ability to split income through these corporations is significantly less than what it used to be. But we'll still talk about it because some of you may be able to take advantage of it. So as Jessica explained in her portion of the presentation, family members of a realtor can own non-equity shares in the professional corporation, which means that they can have non-voting shares. So what that means is they can be shareholders, and technically they can receive dividends from the corporation and pay tax at their marginal tax rates. But, and there's a big but there, so there's nothing in the professional real estate corporation legislation that prevents you from paying dividends to these people, your family members, most likely your spouse or your children over the age of 18. However, it was first proposed in 2017. They have introduced what is called the tax on split income, which us tax people like to use the abbreviation for, which is TOSI. And this tax on split income will apply the highest marginal tax rate on any dividends received by a shareholder if certain conditions are not met with respect to that shareholder receiving the dividends. And the main way to get out of the TOSI and to have an exception from the TOSI on dividends you receive is if you as a shareholder are actively engaged in the business on a regular, continuous, and substantial basis. And what these rules are generally designed to prevent is shareholders who are not active in the business, so usually family members of the active shareholder, from receiving dividends and paying tax at a low marginal rate. And so the rules say that if you are a shareholder but you are actively engaged in the business, then we're not going to apply this high tax rate on your dividends. We're not going to apply the TOSI, and you can pay tax at your marginal tax rate. However, if you're not actively engaged, it's going to be a lot harder for you to pay at your marginal tax rate. Possible, but certain other exceptions need to be met, and they are rare. So let's just talk for a second about what it means to be actively engaged on a regular, continuous, and substantial basis in the activities of the business. Because I think a lot of you are probably wondering, is it possible that my spouse or my children are actually active in my business? And so the first way to get into this, or to meet the criteria, is to pass what they call the bright line test. And the bright line test says that if the person receiving the dividends works in the business for at least an average of 20 hours per week or more during the portion of the year during which the business operates, then they are considered to be active. So if you are going to take that position and you think the facts are such that your shareholder fits into that category, you will need to be able to prove that that particular family member is working in the business for 20 hours per week or more. So if the CRA audits it, they are going to want to see timesheets or payroll records, etc., which I think most people wouldn't have otherwise kept for their family members in the business before, but would probably, or not probably, which you would need to keep these now if you are going to take the position that you are exempt from TOSI because of that rule. And if this bright line test is not met, then you can still show that you're actively engaged on a regular, continuous, and substantial basis, but you have to have pretty good facts that show that. And I won't get into too much of the detail, and to be honest with you, there's not that much interpretation yet on what exactly that means because these rules are new, but generally you're going to have to show that your contribution to the business is continuous and substantial, even though you're not working in the business 20 hours per week. So just to bring it back to a real estate agent's business, in that context, it may be difficult to meet these tests. However, if you have a spouse that is considerably active in your business, then maybe you can get into it and maybe the TOSI would not apply. And just a few other exceptions from TOSI that can apply that might be relevant for you. If the realtor themselves is 65 years of age or older, then the TOSI will not apply on dividends paid to their spouse. So that might be an exception for realtors that are 65 years or older if you are still practicing. And the last thing is just to quickly talk about this. TOSI applies again to dividends paid to shareholders of these corporations. It would not apply if you paid salaries or employment income to your family members for their role in the business. However, there are different rules that apply to salaries paid or wages paid to family members, these are rules that apply to salary or wages paid to anyone generally. And basically those rules say if the remuneration paid is not reasonable in relation to the services provided to the corporation by the person receiving the wages, then the corporation can lose the ability to deduct the remuneration from their taxable income. And that can result in a very high effective tax rate because essentially the corporation will pay tax on the income without getting the deduction for the salaries, and that the person receiving the wage will pay tax as well. And therefore, if you're paying an unreasonable amount of employment income to a family member, you could end up in a pretty bad situation tax-wise. And so really, I think the takeaway from that is there's no real bright line test like there is for the TOSI. It's more of a question of reasonability. But that being said, if you pay your family member a reasonable salary for the services they provide to your corporation, and that means that they don't necessarily have to be working full time, they just need to be having they just need to be working enough to justify the salary you're giving them, then that ability to pay a salary to that family member is there. So that's income splitting. And again, I think unfortunately, because of the TOSI rules, unless you have an active family member, it's going to be difficult to take advantage of those income splitting opportunities, more difficult than it otherwise would have been a few years ago before they introduced the TOSI rules. Okay, and then let's just quickly, I'm going to talk about the last topic for a little bit, which is transfer of assets to these professional real estate corporations. Now, if you are currently operating a real estate practice, You may have certain assets that you have claimed tax depreciation on in the past on your personal tax return. I think my thinking is that the principal assets that realtors would have in their business, and I know it's not a capital intensive business. I don't think there's too many realtors that are investing in heavy machinery or manufacturing equipment in order to carry on their real estate business. But I do know from my experience and my clients that are realtors that a lot of you will own an automobile that you claim CCA on against your self-employment earnings. You might have certain office equipment. You might have computer equipment. And you may have intangibles. I'm going to get a little bit into a deeper discussion about that after. But I think the principal ones are probably going to be automobiles, office equipment, computer equipment, etc. But if you do have those assets and you want to transfer them to your corporation, there are certain rules that allow you to do that on a tax efficient basis. And the principal one is Section 85 of the Income Tax Act. Now, Section 85, and again, I think we'll get into the specifics of it, but I think that because it's not a capital intensive business, this won't necessarily be as relevant to a lot of you, but I think there's some relevance that can be gained from this. But what Section 85 of the Income Tax Act allows you to do is it allows you to transfer assets to a corporation and take back, in consideration for the transfer of the assets, shares of the corporation and maybe other consideration, which we'll talk about in a second. And if you do the transfer under Section 85, it can be tax deferred, which means that if you have an unrealized gain on the property that's being transferred, there's not going to be any tax payable on the transfer as a result. And so in other words, if you didn't do it under Section 85, and let's say the asset had a value that was in excess of its tax cost, you would be deemed to realize that gain and pay tax on the gain if you transfer the asset in. However, if you do it under Section 85 on a tax deferred basis, that tax won't kick in on the transfer of the assets to the corporation. However, as we talked about before, if the majority of realtors are holding property that is say office equipment or automobiles, chances are those aren't really assets that appreciate in value, and chances are the tax cost is probably not going to be less than the fair market value at the time of the transfer. So I bet you're wondering why is he talking about this if it's not that relevant? Well, the first reason I'm talking about it is because if you look at the rules of Section 85, in addition to taking back shares on the transfer, the person that transfers the assets can also take back debt due to themselves up to the cost amount of the property transferred. And what that means is, let's say, I'm going to use an example because this might help you understand this a little bit better. Let's say yesterday you bought a brand new car for $25,000 and you're using it in your real estate practice. That car has a tax cost, an amount you can claim capital cost allowance or depreciation on of $25,000. You can then transfer that automobile to the corporation and take back a note receivable or an amount payable to you equal to that $25,000 tax cost on the transfer. And what that means is now the corporation owes you $25,000. It has a debt payable to you of $25,000. And why that can be beneficial for you is because, as we talked about before, when you take money out of a corporation, you're going to pay personal tax on that money, and the deferral that's otherwise available on those corporate earnings is that now lost once you take the money out. However, if you have transferred assets to the corporation and the corporation now owes you debt, that's an amount that can come out of the corporation without incidence of personal tax. So if you transfer these assets, you take back debt, or what we call, in tax terms, we call it boot, but it's debt. If you take that back on the transfer, you may be able to take money out of the corporation in the future without paying additional tax on it. So that can be somewhat powerful, and I'm going to talk a little bit more on the next slide on what type of assets can be transferred to a corporation. So Section 85 of the Income Tax Act limits assets that can be transferred to a corporation to what are called eligible property. And eligible property, some of it is pretty obvious. It's like what we talked about before. Office equipment or automobiles would be a good example of depreciable property. Another example of a depreciable property, and I don't know how relevant this will be for you, but I would like, if anybody thinks otherwise, I'd be very interested to hear about it, because you guys probably know more about this than I do. But technically, if you have some sort of intangible asset associated with your real estate practice, so if you have a value to a customer list, or just a general intangible in terms of the value of your business, Section 85 does allow you to transfer that asset, if you can put a value on it, to the corporation. Now, the reason I put a question mark there, and again, this is what I'm curious to hear about from you guys, if you have any comments on it, is would you have any intangible value associated with your business? I mean, do your client lists have value? I guess it depends on the type of clients you're working with. I mean, I think maybe if you have clients that you're working with on a lot of different transactions, then maybe there's some value in recurring clients, and a customer list might have some value. But I'm not sure. But by the letter of the law, let's say, if you did have goodwill associated with your real estate business, or if you had an intangible asset associated with it, technically you could transfer it to the corporation. And what that also means, I'm not going to get too much into the technical on this because it's complicated, but I'll just talk high level about it because I think it's a possibility. What that also means is if you had an asset, or if you had a value associated with your real estate business, and let's say you could sell the shares of your professional real estate corporation at some time in the future to a buyer, another real estate agent that wanted to buy the shares, if that was possible, you may be eligible to claim what's called the once in a lifetime capital gains exemption on the sale of your shares of this professional corporation, which means that you might be able to sell the shares and realize the gain without paying any personal tax on the capital gain you realize on the sale. Now, again, the shares would have to have value for that to be feasible, and there's a number of other conditions that need to be met in order to get there. But I think it is a possibility if you did have value in your real estate practice and you had value in the shares of this corporation. So another thing to think about, and if anybody has any thoughts on that, because you guys know probably more about the value of these businesses than I do, I'd love to hear about it, because as we're structuring these things, we're going to have to consider these things with the agents to determine these valuation questions. And then the last thing I want to talk about, and then I think we'll then take a little time to do questions, is the idea of transferring inventory to a professional real estate corporation. And I think a lot of you might be thinking, well, I'm a real estate agent. What sort of inventory do I have? I don't sell widgets. I don't have any hard inventory. However, a lot of you may at this point have what I'm referring to as listings in progress. So you may have certain listings that you're working on at this time. You haven't closed the deal yet. You haven't earned any commission yet, but you are working with a potential buyer, potential seller to sell a particular property. And the question then is, would those listing in progress, would those be considered work in progress inventory for the purposes of eligible property for the Section 85 transfers? Now, because these professional real estate corporations are new, and because there isn't necessarily detailed legislation out there, or detailed interpretation out there, or case law either issued by the CRA or the Canadian tax courts that talk about this issue, it's unclear how the CRA would view that type of transfer. But what is work in progress inventory? I mean, it's really work in progress, like it sounds, for which you haven't necessarily earned the income yet, so you haven't made the sale or earned the commission. However, it is in progress at this time. So, and there is a lot of technical interpretation out there that says that work in progress inventory is inventory that is eligible for a transfer under Section 85 to a corporation. So if these listings in progress were to be considered work in progress inventory, which it seems like based on the nature of work in progress inventory that they have that characteristic, then a transfer under Section 85 to a corporation would be possible with that. And the reason that might be beneficial to you is because if you are thinking of setting up this professional corporation and you have these listings in progress, at this point, you may be able to transfer them to that corporation and then have, when the income is actually realized, the commissions are actually realized, it would be realized and taxable in that corporation as opposed to yours. And just a last point on that, there is a provision in the Income Tax Act that does talk about when a particular person is entitled to a right to income and they transfer it to another person, which is essentially what happens here. They could apply this rule to say that the income is taxable to the person that transferred the asset. However, we think there's a fair amount of strong case law that says that wouldn't necessarily apply in this case, and that I think if we did want to do a transfer of listings in progress to a professional corporation, we'd have to look at all the relevant facts and determine on a case-by-case basis to see whether it fits into the criteria, but on a case-by-case basis, we might determine that it's possible. And that's it for me. What I think we're going to do now is take a look at some of the questions and try to get through a few of them. Here is our contact information. Again, I'm Jason Simon. I'm a senior tax manager at Kraft Berger. Jessica Jin is an accounting manager here. This is our contact information if any of you want to speak to us offline after the presentation. We have recorded this and can make it available. So if anybody wants to tune in and look at it after, we will be happy to try to get it available to you. So just give us a moment to look through the questions. I don't know, Jess, have you been looking at them? Do you maybe want to start? Do you have any in mind that you might want to?
Okay.
Yeah.
Okay. The first question is how capital gain compares to income earned in PC. Is the max still for $50,000? The max the AAI earned, the investment income earned in the corporation is the small business deduction will start to grant down after 50K, but you will still get some small business deduction between 50K and 150K. The answer for the question is yes, the threshold is still the same. However, the capital gain, only eligible portion of taxable capital gain will be included in the formula. First, for the capital gain earned from investment income, only 50% of it will be included in these in the calculation, which is taxable capital gain. Second, only eligible taxable capital gain will be included. For example, you have capital gain from the disposition of active assets, for example, the car that you use to earn your active business income, then that portion of the capital gain is taxable capital gain is not part of the calculation. Okay, so for the next question, what if the spouse or family member is a broker or salesperson? Can they own the voting shares or equity shares? Based on the wording in the legislation, it seems that for one of the PREC only has one controlling shareholder. Basically, you and your spouse need to incorporate two separate corporations. In addition, if both of you have higher income, there are some beneficial. It's beneficial to incorporate two separate corporations because the two corporations, if you only own the shares of one corporation and your spouse only own the shares for the other corporation, these two companies are not associated, which means both of them will have the 500K small business deduction available to utilize.
Okay, thank you, Jessica. Okay, I can answer one of these questions here. So someone has asked, what about real estate investment property held in the corporation, do you risk realizing the sale of the real estate as income? And I think what the person is asking there is, if you have real estate investment property held in a corporation, does the fact that it's held in a corporation maybe increase the risk that if you sell it, the gain on the sale of that asset will be taxed as regular income as opposed to a capital gain, which would be 50% taxable? So my answer to that question is really real estate investment property. It doesn't matter whether it's held in a corporation or whether you held it personally. What's going to determine what the tax rate is going to be on the sale is what the intention is of holding the property. So in other words, and there's a whole bunch of income tax case law on this concept, but if you basically the basic rule is if you hold property and your intention is to sell it and realize a gain on the sale, then that income on that gain would be taxed as fully taxable income. However, if your intention is to earn, say, rental income from the property, or not, your intention is not necessarily to profit from the appreciation in value, but to profit from the rental income, then if you then sell the property, then that would generally be taxed as a capital gain. And I'm just looking at the question now. So I think the individual is asking, I was thinking more because it's a real estate business. I think that the fact that it's held in a corporation, I don't see that has any impact on the way it would be taxed. I mean, there is some case law that says that corporations generally carry on a business, and that income earned through a corporation is usually business income. That being said, I don't think the fact that it's held in a corporation is really going to change whether it's a capital gain or whether it's taxed on account of income. I think that would be more a question of what is the intention in holding the property from the beginning. Are you holding it to profit from gaining on the sale and the appreciation of value, or are you holding it to profit from, say, rental income? Okay, let me just look to see if there's any other questions. More here. Someone asked, can cash be transferred into a PREC? Yes, I don't see why not. You could transfer cash into not only a PREC, but into any corporation. And if you did that, usually you would either transfer the cash and take back debt like a shareholder's advance, or you would transfer the cash and call it a subscription for share capital, and call it the paid up capital as shares, so you could then take it out tax-free either way you did it. And I don't see why you couldn't do that. And I think that is all. Okay, hold on. Okay, there's one question that is, will you be able to address the additional implications of being a U.S. citizen, or is that another webinar? That is definitely another webinar. What I can say, very generally, and I'm not a U.S. tax specialist, so I can't give any sort of U.S. advice, is that as you probably know, if you're a U.S. citizen, U.S. citizens do tax their citizens on their worldwide income, regardless of whether or not they're residents in the U.S. So if you are transferring assets under Section 85 to a PREC, or if you're trying to transfer assets under Section 85 to a PREC, or really if you were looking at the combined tax rate that you would realize on taking money out of a PREC, or the deferral that would be available to you, there would be considerable additional complications, because you would have to look at the U.S. implications of all of those transactions, and the money going in and out, the transfer of assets, the money coming out as dividends or salary. And it would be a much more complicated analysis to determine what your effective tax rate would be on the income earned through the PREC. I don't think it's impossible to make it work or to look at it, but I think it would be a far more complicated process. And like you said, a totally different webinar. Wondering if there's anything. Okay, one more question. And I think I'm just checking the time here. I think I'll answer one more question, and I think we're going to cut it off because we're getting close to the time deadline. Please explain the implications if both realtor and spouse are over 65. So in terms of income splitting, if the way the TOSI rules work is if the realtor themselves is over, the question is the realtor themselves over 65? Because if the person who is active in the business is over 65, then the non-active spouse can receive dividends without the TOSI applying. So it's not how old the spouse is, it's how old the active individual is. So if the active individual is over 65, the TOSI shouldn't apply on dividends paid to the spouse. Okay, I think that's all the questions, and I think that's it. Again, if anybody does think of an additional question or wants to ask anything to Jess or I after this, please feel free to email us or call us. And we thank you all for tuning in and listening, and hopefully this was informative and helpful for all of you. So have a great day.
Thank you, everybody.
Bye.